All right, folks, welcome back to the channel. Grab your coffee, maybe something stronger, because we need to talk about what just went down on Wall Street. On the 3rd of September, a company called American Bitcoin, ticker ABTC, hit the Nasdaq, and it didn't just walk in, it kicked the door down, lit a firecracker, and did a backflip. The stock, which has deep, and I mean deep, ties to the Trump family, opens at around $7, and within minutes, it skyrockets over 100% to more than $14. The frenzy was so wild, the exchange had to hit the brakes and pause trading multiple times. Now, a crazy IPO day isn't exactly a unicorn on Wall Street, but this wasn't just another crypto company going public. This was something different. This was the premiere of a new blockbuster movie starring three of the most powerful forces of our time: a massive political dynasty, the speculative mania of cryptocurrency, and the dark arts of Wall Street financial engineering. What we're seeing with ABTC isn't an isolated event, it's the playbook. It's the perfection of a model that's turning public companies into something else entirely: high-stakes proxies for digital assets. Today, we're going to dissect this beast. We'll look at how American Bitcoin pulled off its explosive debut, who's really pulling the strings, and how it fits into a much bigger, wilder game that's rewriting the rules of corporate finance. This is the story of the crypto stock nexus, and trust me, you need to understand how this machine works. So, how did a company with the Trump name stamped all over it just appear on the Nasdaq? They didn't do a traditional IPO. That's slow. That's for dinosaurs. Instead, they used a classic Wall Street shortcut, a reverse merger. Think of it like this. ABTC, a private company, found a publicly traded but smaller crypto miner called Griffin Digital. Instead of building their own car to get to the Nasdaq highway, they basically bought Griffin's car, threw the old driver in the back seat, and took the wheel. After the deal, the original ABTC shareholders, including the Trumps and their partners, owned a whopping 98% of the new company. The old Griffin shareholders, they got diluted down to a measly 2%. This wasn't a merger of equals. It was a hostile takeover disguised as a handshake. And the market ate it up. That first day of trading, with the ticker now proudly displaying ABTC, was pure chaos. The stock's volatility showed just how potent this cocktail is. You take the hype of a crypto bull run and mix it with the MAGA-level brand recognition of the Trump family. The result is a retail investor magnet. Now, let's look under the hood at who owns this thing. It's a bit of a web. The majority shareholder with an 80% stake is another publicly traded Bitcoin miner, Hut 8. The other 20% is held by an entity called American Data Centers, and guess who the key investors are there? Donald Trump Jr. and Eric Trump. Eric isn't just a silent partner either. He's the co-founder and chief strategy officer. His job is to be the face, to leverage that billion-dollar brand name, and boy, did it pay off. By the end of day one, the brothers' stake was reportedly worth over $1.5 billion. Not a bad day's work. But here's where it gets a little murky. Hut 8 isn't just the main shareholder, it's also the only key service provider. ABTC is essentially an empty shell that outsources all its heavy lifting, the data centers, the mining rigs, the management, to its own parent company. This is a classic related party transaction setup. It creates a massive potential conflict of interest. Hut 8 could charge its subsidiary ABTC sky-high fees for its services, effectively sucking value away from ABTC's public shareholders and funneling it back to themselves. It's a governance red flag the size of a football field. So what does ABTC actually do? Their business model is beautifully simple and brutally effective. They call it a dual accumulation strategy. 1. They mine Bitcoin. Thanks to their deal with Hut 8, they can produce Bitcoin at an industrial scale for roughly half of what it costs to buy on the open market. That's their structural cost advantage. 2, they buy Bitcoin, they take money from investors and go out and buy Bitcoin directly from the market. The ultimate goal here isn't profit in the traditional sense. It's not about selling a product. The goal is to maximize one metric and one metric only: Bitcoin per share. This is a concept pioneered by another company we'll talk about in a minute, MicroStrategy. The entire company is a machine designed to do one thing: Accumulate as much Bitcoin as humanly possible. And to fuel this machine, they need capital, lots of it. Just this past June, ABTC raised $220 million in a private placement from some big crypto names, like the Winklevoss twins. That money has one purpose: buy more machines and buy more Bitcoin. This isn't a self-sustaining business. It's a capital-intensive financial game. It's a leveraged bet on the price of Bitcoin, wrapped in a Nasdaq-listed stock and marketed with one of the most famous names in the world. Now, as clever as the ABTC setup is, they didn't invent this game. They're just the newest, most politically charged students of a master. The architect of this entire playbook is Michael Saylor, the CEO of a software company called MicroStrategy. Back in 2020, Saylor did something that made everyone in corporate finance either scratch their heads or call him a genius. He took his company's cash reserves and started buying Bitcoin. His argument was simple. In a world of endless money printing, cash is trash. Bitcoin, he argued, was digital gold, a superior way to store value. But it quickly morphed into something far more radical. It became what the market calls the infinite money glitch. Here's how the flywheel works. 1. Buy Bitcoin. MicroStrategy buys a ton of Bitcoin. 2. Bitcoin price rises. The crypto market goes on a tear and the value of their holdings explodes. 3. Stock price rises even faster. Here's the magic. The market starts treating MicroStrategy's stock as a leveraged way to bet on Bitcoin. For every 1% Bitcoin goes up, Mississippi TR might go up 2% or 3%. This creates a massive premium. The company's stock is worth way more than the actual assets it holds. 4. Borrow cheap money. Saylor then uses his ridiculously overvalued stock as collateral to borrow billions of dollars at near zero interest rates by issuing convertible bonds and new shares. 5. Buy more Bitcoin. He takes that newly raised cash and, you guessed it, buys even more Bitcoin. 6. Repeat. This signals to the market his unwavering conviction, which pushes the stock's premium even higher, allowing him to borrow even more money. Rinse and repeat. Saylor transformed a boring software company into the world's largest corporate holder of Bitcoin. The company's value is no longer tied to software sales. It's tied to Bitcoin per share. He opened Pandora's box, showing every public company how to turn itself into a financial instrument. And now, we see this playbook evolving into 4 distinct models across the market. Model 1, the leveraged accumulator. This is the MicroStrategy and American Bitcoin model. The company's sole purpose is to accumulate a specific asset, like Bitcoin. They use debt and equity financing to relentlessly buy more. The stock is a pure leveraged derivative of the underlying crypto. Model 2, the integrated operator. These are the big, publicly traded Bitcoin miners like Marathon Digital and Riot Platforms. Their main business is producing the asset. They mine Bitcoin and then, instead of selling it all for cash, they hold it on their balance sheet. Model 3, the conservative allocator. Think Tesla. This is a non-crypto company that takes a small slice of its corporate treasury and buys some Bitcoin. The goal isn't to become a Bitcoin proxy, but to diversify its cash holdings and hedge against inflation. Model 4, the yield generator. This is the 2.0 version of the accumulator model, but for cryptocurrencies like Ethereum or Solana that use a proof-of-stake system. Companies like SharpLink don't just buy and hold ETH, they stake it. By locking up their coins to help secure the network, they earn a yield paid out in more ETH. This is a game changer. It turns a passive asset into a productive cash flow generating one. The yield can be used to pay off debt or reinvest, creating a powerful compounding effect. This model turns the stock market into a battleground between blockchain ecosystems. A bet on MSTR is a bet on Bitcoin as digital gold. A bet on a company like SharpLink is a bet on the entire Ethereum ecosystem's economic activity. This all sounds amazing when crypto prices are going to the moon. This flywheel creates wealth at a dizzying speed. But what happens when the music stops? What happens when the crypto market turns, as it always, inevitably does? That's when the flywheel spins in reverse and it becomes a death spiral. The core risk for the leveraged accumulators is, well, the leverage. They've borrowed money to buy a volatile asset. When Bitcoin's price crashes, their stock price plummets even harder. That juicy premium vanishes overnight. Their ability to raise more cheap money evaporates. Suddenly, they have billions in debt coming due, and they may be forced to sell their Bitcoin at the worst possible time at the bottom of the market just to stay solvent. This forced selling puts even more downward pressure on the price, which crushes their stock further. You see how this death spiral works. For shareholders, there's the slow poison of dilution. Every time these companies sell new stock to buy more crypto, they're watering down your ownership. The bet is that the value of the crypto they buy will grow faster than your stake shrinks. If the price of Bitcoin stagnates or falls, you lose on both ends. This whole game is built on a fragile foundation of market sentiment. The premium is just a story the market tells itself. When that story changes, when the confidence breaks, it can all come crashing down. So, what are we looking at here? Is American Bitcoin and the rise of the crypto stock nexus a legitimate financial innovation, a new paradigm for corporate strategy? Or is it just the craziest, most elaborate symptom of a bull market bubble, a house of cards built on leverage and hype, destined to collapse in the next crypto winter? The truth is probably somewhere in the middle. The more conservative models, like Tesla's likely stick around as a niche treasury strategy. But the high flyers, the leveraged accumulators like ABTC and MicroStrategy are in a high-stakes experiment. Their survival through the next brutal bear market will be the ultimate test. One thing is for sure, this wave has fundamentally changed the game. It has blurred the lines between corporations and investment funds, between technology and finance, and between politics and speculation. And it is a story that is far from over. Thanks for watching. Don't forget to like, subscribe, and hit that notification bell. And as always, do your own damn research. This is not financial advice. This is the wildest show on earth. See you next time.